Hello, people of Zion. All right, whether you bought your crypto, were paid in it, gifted it, mined for it, used a website or browser that rewarded you in it, sold an NFT for it, twerked for it, or stole it, the final question of this series remains, how do I transform it into an investment vehicle that will turn a profit for me? All right, so last week in the first part of this final step 4 of my investing in cryptocurrency for beginners series, I went over what I suggest you do mentally when investing in crypto. And in this last part, I'm going to go over the top investment strategies that you can use action-wise to get that crypto to turn into more crypto while you sleep. All right, you ready? Let's do it. Welcome back, the Oracle from the blockchain here, and happy to help guide you through the golden crypto country. Now remember, I am not a financial advisor, so everything in this video is for edutainment purposes only. All right, simply put, when it comes to making money or getting a return on your investment in crypto, all you really have to do is buy low and sell high. So thanks for watching. Don't forget to like. No, I'm just kidding. No, and to do that, you can employ 3 types of investment strategies, and they're under 3 different umbrellas. When it comes to types of investment strategies, you got your long-term investing, your short-term investing, or a mix of the two. With long-term investing, you are hodling or holding your open position for months or years with the hopes that in that time frame, the value will continue to rise so that you can sell it at a profit. A lot of people hold for at least a year because after that, in a lot of places, the capital gains taxes are a lot more favorable. And here, as with any strategy, you have your exit plan firmly in place. You know, this will dictate when you take profit or a partial profit so that you aren't panic selling if the price dips or holding on for too long if the price looks like it's continuing to rise. With the long-term strategy, you really don't have to worry about trying to figure out when the best time to buy is or anything like that, because you're expecting the value to increase over a long period of time. So that'll allow you to take profit pretty much anytime you jump in. And that's an advantage of the long-term strategy because no one can time the market, as reflected in the saying, time in the market beats timing the market. However, for those still hoping to get a good deal, some dollar cost average, which involves spreading out your investment and buying at predetermined intervals of time, whether it be weeks, months, or whatever, or they average down and invest more when the price dips. And that's also a way to increase the size of your investment over time. But remember, we are only investing what we're okay losing. You know, the amount we're okay losing. So once you reach that max, don't keep buying the dip just because everybody on Twitter keeps yelling it at you, okay? Unless they're willing to give you the money to do it, then buy the dip. Like into infinity and beyond, to the moon, okay? With short-term investing, you are buying and selling within a matter of days, weeks, or a couple months. Here you are trading off of things like technical analysis or news and events, so you're having a lot more active management of your portfolio. And if you do not have experience as a professional day trader, please, for the love of God, do not play one now, okay? You will lose your money. Even the most experienced day traders frequently lose money. It requires lots of skill, lots of technique, and lots of education. So if you are interested in trading in that fashion, please go get educated in it first, and preferably not from the scammers in the comment sections who are trying to get you over to their mentors or whatever over on WhatsApp or Telegram. And then the final form of investing, which is a mix of the two, basically requires you to be hodling with some of your funds, and maybe you're storing that in a separate hardware wallet and using another portion of your funds for more active short-term investing. Now within those 3 strategies, you can employ even more tactics to increase gains. Some say, why just hodl when you can earn even more crypto on crypto that's just sitting there, and do things like stake. Staking is when you help stabilize a coin or a token by agreeing to hold on to it for a set period of time in exchange for interest rewards or a percentage of the node's fees or whatever in the network's native currency. And for those who are looking to earn more and are even more adventurous, and I say more adventurous because the higher the risk, the higher the reward. And don't just hear reward, hear risk too, because you are being compensated because you have a greater risk of losing your crypto. That's why they're giving you all this extra stuff. They turn to yield farming, which is also known as crop rotation. And this is where you try to maximize your returns by chasing yields and leveraging different strategies. It is thundering now. It's raining and thundering. All right. Here you are looking to either earn more interest, compound interest, earn rewards in the form of tokens that increase in value, stuff like that, in exchange for lending your crypto out to other users, whether they be institutions, hedge funds, market makers, whatever, leveraging your crypto with borrowed funds and collecting on the margin, or providing liquidity to the marketplace in exchange for things like fees or tokens that will increase in value. And the last option is so popular, it's often synonymous with yield farming itself. And it's called yield farming or crop rotation because you're constantly having to move funds around or swap coins for ones that are generating more yield. And there are a lot of websites and networks that are created to help you manage it all. But know that this is a very, very active form of management because protocols are changing all the time and there are a lot of risks involved. There are things like impermanent loss and liquidity pool attacks and stuff like that. And for a more detailed, explanation of these options and the very real risks that come with them, I highly recommend you check out the YouTube channel Finematics, because that guy does a great job of breaking it all down for you and, let him know I sent you in exchange for a free hamburger that you are sure not to receive. And it'd be remiss if I didn't mention it. So when it comes to formulating your strategy, don't forget that unless you want to become a criminal by lying on your tax returns, which I'm sure some of you probably are okay with, you will be asked to render unto Caesar the things that are Caesar's. So calculate your taxes. Make sure that you include that in your investment strategy. Here you're going to want to consult with a tax attorney because I ain't touching that with a 10-foot pole. Now, there are 3 umbrellas under which these investment strategies in crypto take place. There is DeFi, decentralized finance, CeFi, centralized finance, and CDFi, centralized decentralized finance. DeFi is the financial system that upholds blockchain's goal of decentralizing transactions. Okay, here everything still remains trustless and permissionless as you maintain control over your private keys or crypto the entire time due to not handing them over to a custodian at any point in the transaction process. CeFi is a financial institution that consists of what's considered crypto banks because it follows the traditional banking model where you turn your funds over to a custodian, but instead of using fiat, they use crypto. However, for those who don't really care about decentralization but are still hoping to potentially profit off of crypto, given how volatile the marketplace is and time-consuming it is to keep up with, it may make more sense to simply expose yourself to the gains in crypto via the traditional stock market by investing in crypto EFTs or funds or companies that have a stake in it. CDFI, whose term I believe was coined by Binance's CEO, is a mix of the two based on the fact that at least one point of the process uses a custodian. It's centralized. Like maybe it uses wrapped Bitcoin, which uses a custodian to expose Bitcoin to a DeFi protocol. Some consider CDFI BS, saying that using a custodian basically defeats the whole point of using DeFi, and others consider it a consumer-friendly stepping stone from CeFi to DeFi. So, as you can see, when it comes to investing in cryptocurrency, you're gonna have to make a lot of important decisions beyond the ones I encouraged you to look at in the last video. Assess your risk level and honor it. Decide how active you want to be and can be given your experience level. Evaluate where you think the marketplace is going based on your research, and also take into account if you want to support decentralization, because its tools were designed to change the world. And here you get to vote with your dollars on if you want to support that change. All right, remember, investing is for added peace of mind. So make sure you get to know the ins and outs of what you're investing in. And don't put more into the marketplace than you're okay with losing. And most importantly, remember that everything you need, you already have. And until next time, this is the Oracle from the blockchain, reminding you to eat a cookie.